It was an interesting day on the markets as most of the indices were lower, with the exception of the Russell 2000. The small cap index did finish slightly higher today, and it retains its bullish intermediate posture. The S&P 500 fell today, but it also retains its bullish posture. In fact, it ended with a bullish intermediate confirmation signal. However, there was enough of a pullback in the NASDAQ Composite and the Dow Jones Industrial Average to now warrant a weekly bearish posture according to the market forecast. We're going to take a look at all that. We're going to talk about some of the corporate events today, including earnings and a lot of different shakeups in the C-suite from Under Armour, Nike, ServiceNow, Boeing, etc. And then we're going to get into our trade application example where I'm going to feature a bearish trade on a stock that is on the NASDAQ Composite, which just went bearish here today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 22nd, 2019. First of all, if you're new, welcome aboard. Remember to go to our YouTube channel, click subscribe. Also, while you're there, check out our description area where you can sign up for our email distribution list. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee. I would encourage you to follow me there, and thank you to everyone who clicks like and retweet on these Market Outlook related posts. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into the charts. As you can see, I've got chart 4B pulled up here in front of us. And the S&P 500, as mentioned in the intro, was down here today. It was down 0.36%. So that means we closed below 3,000 again. It seems like that's kind of been a tug of war zone for the markets. Oftentimes those big round numbers are. You'll note that we touched 3,000 back here in July. We touched it again here in September, and we touched it again here earlier in the last 48 hours. And so back and forth we go. As it stands right now, we retain that bullish posture on the S&P 500. You can see that with that background color, that darker shade of green right there. And like I mentioned in the intro, you could actually make the case that this is a bullish intermediate confirmation signal because you have the green line that's still in the upper reversal zone, warranting a bullish posture from an intermediate perspective. And at the same time, the red line is in the lower reversal zone. Now, having said that, this is not one that we would consider to be an ideal trade setup when it comes to the bullish intermediate confirmation signals. Remember that in an ideal world, we'd also like the blue line to be somewhere below 50, but above 20. Right now, the blue line is right here at about 73. In addition to that, we have this red line that's way down here, an extreme move all the way down here to 2 on the red line. Remember, it can only go to 0, just to give you a sense of how close to 0 that is and how extreme that is. Oftentimes when moves get that extreme, meaning below 5, the tendency of that bullish intermediate confirmation signal to work out and have success is lowered. So make sure you understand that, and if you are placing trades based off of that bullish intermediate confirmation signal, perhaps you would do smaller position sizing or something along those lines. Now, having said that, I did want to point out a couple of changes to our posture, and that did occur today with both the Dow Jones Industrial Average and with the NASDAQ Composite. You'll notice that the background color of the Dow Jones's chart is now red or pink, and you'll see the same thing over here with the NASDAQ Composite. Now, having said that, the charts do look slightly different from the moving averages perspective. Note that the Dow Jones's moving average is now red, meaning that price is below a falling 30-day moving average, whereas the NASDAQ is still a green moving average because price is still above a rising moving average in that case. However, you will note that the NASDAQ Composite was the worst performer of the day of these four indices. It was down 0.72%. And you can see that that's a pretty aggressive looking candle right there as well. In fact, that would be known as a bearish engulfing pattern that we're dealing with there with the NASDAQ Composite. So a little bit more bearishness on a one-day basis. And we saw that with a lot of those cloud computing stocks. In fact, we had this conversation in my class yesterday, my top-down trend trading class. And I was showing some of our students some of our exit points of our cloud computing stocks earlier in the fall, and how a lot of those didn't feel great to get out when we did, but looking back with hindsight right now, we recognize that we are quite thankful that we got out when we did, because it has only gotten worse with a lot of those cloud computing stocks. And of course, many of those reside there on the NASDAQ composite. The Russell 2000 is worth mentioning, as I noted in the intro. It actually closed higher today. Not a lot, but hey, a win is a win. It was up 0.05%. And it retains its strongly bullish posture as dictated by that deep green or that darker green shade that we have on the background color. And of course, we remain above a rising moving average there as well. All right, so with that information regarding our postures out of the way, let's go ahead and advance now to a new set of charts. In this case, let's go ahead and talk about our 3 green arrows analysis. And this will be chart 4D for those of you that are premium members of Market Scholars following along at home with your own charting package. Now remember, this particular view is going to denote something different when you see the background color be either pink or green. In this case, this is our 3 green arrows setup. And so when you see a green background color like we do here with the S&P 500, for example, that means we have 3 green arrow signal in play right now. We have green arrow number 1 with the stochastics, green arrow number 2 with the MACD histogram, and there's green arrow number 3 with the 30-day moving average. So right now, the S&P 500, the NASDAQ composite, and the Russell 2000 all have 3 green arrows signals. The one that's the missing link in this particular case is the Dow Jones Industrial Average. You'll notice that today we got 1 red arrow to sink into place there as price closed below that moving average. And therefore, we have 2 green arrows on the Dow and 1 red arrow. So things are starting to weaken up a little bit here. And of course, not ideal that the markets are starting to run into a little bit of turbulence here right around the levels where it had horizontal resistance. As mentioned on the S&P 500, we dabbled with the 3,000 level a couple of times already, but as you look at all of these charts, you can kind of see those, key horizontal areas that we've battled in the last 3 months or so, and it's not great to see the markets kind of backing off here like we saw today. Now, I noted in the intro that there were some C-suite shakeups, and one of the stocks affected was Boeing. And so remember that the Dow Jones Industrial Average is a price-weighted index, meaning that it is influenced by stocks that have higher prices per share and less influenced by stocks that have a lower price per share. That's a different concept than what you naturally find with, let's say, the S&P 500, which is a market cap weighted index. And so a stock like Boeing is one of, if not the most influential stocks on the Dow Jones. And you can see here in the last 3 or 4 days, things have been pretty ugly for Boeing. Now today, they did have a key departure in their commercial aviation division, and the stock was able to rebound a little bit as a result. But for those of you following the news, you'll know that the news cycle has not been kind to Boeing here recently. So knowing that, we shouldn't be entirely surprised to see that the Dow is the only one that has the red arrow on the moving average right now, because in large part, there's been aggressive selling in Boeing shares. All right, let's go ahead and take a look at a longer term chart now. In this case, it will be the chart for C. There we go. It's the 1040 crossover method. Not a whole lot to report here. Remember, we don't get a lot of changes here, so we don't want to spend a lot of time on these charts. Basically, just give you a quick update and get on with things. But we're in that same holding pattern that we have been for the last several weeks, which is 3 out of the 4 indices, in this case S&P 500, Dow Jones, and NASDAQ Composite, all have bullish crossovers. And they've had bullish crossovers basically since February or March of this year. So nothing new has changed there. Where we have had some flip-flop action has been in the small caps. You can see the Russell 2000 in the lower right-hand corner there. And that background color of the chart will tell you whether we have a bullish crossover with the 10-week moving average and the 40-week moving average, or whether we have a bearish crossover. And when we have the pink background, as we do right now, it means that the 10-week moving average continues to reside below the 40-week moving average. Now you can see that it's awfully close. In fact, with the bullishness in the Russell 2000 today, that's a good sign that perhaps there's folks that are willing to bid up shares of the small caps. Remember, one of the features of the market is that typically as we approach the end of the year, there is kind of this small cap philosophy that starts to take hold in the marketplace, where small caps start outperforming large caps. Now, whether that's going to happen this upcoming year or not is anybody's guess, but a lot of times that does happen, and oftentimes it's around December and in January as you're starting to do some tax planning and different things like that. But reason I'm bringing that up now is just to look ahead and to see where we're at right now. We are just barely with a bearish crossover right now. You can kind of see, in fact, let me right click and go to maximize sell so you guys can see this a little bit better. You can see that orange line is just barely below that blue line right there. I mean, it's hardly even noticeable to the naked eye. So with today's or this week's candle, now this includes both yesterday and today, and of course is not completed until Friday afternoon since these are weekly candles, but that's a pretty nice looking candle that we have right there thus far. And so if we can get a couple more candles that look like that in coming weeks, we could very well be seeing a bullish crossover occur sooner rather than later on the Russell 2000 to join all of the other three indices that I mentioned earlier. Let's go ahead and now do some 12 grid analysis. So starting with chart 5A, this is our asset classes 12 grid, and as a reminder, the background colors of these charts will tell you whether the market forecast technical indicator has a bullish or bearish posture using the intermediate term line, that's the green line on the market forecast, and the difference in shading will tell you whether that posture is weak or strong. And so, for instance, right here in the middle, foreign bonds did have enough of a oomph here today to give us a weakly bullish posture. However, high yield bonds, just to the right of it, has that darker green shade there. There we have a strongly bullish posture. And what distinguishes those two is whether the intermediate line is above 50 or not. In this case, notice that the foreign bonds intermediate line is at 21 and rising. So as long as it's above the lower reversal zone of 20 and rising, we would consider it bullish. Since it's just barely above that and not quite to the chart's midpoint at 50, then we would consider that weakly bullish. In the case of the high yield bonds, you'll notice that their intermediate line is at close to a 74 reading right now, which is of course well above 50, and therefore we would consider it strongly bullish. All right, real quick here, you can see that the SPY also looks like it has a bearish engulfing candle here today, but it retains its bullishness as of this moment in time. We've been talking a lot about foreign stocks here in recent presentations. Many of you read my write-up yesterday. Of course, we've been mentioning for a while now that David is on vacation this week. So yesterday, I teach two classes to my premium students, my top-down trend trading class and also my options for long-term investors class. So I don't have the ability to do the market outlook video in addition to those two obligations. But I did make the paragraph write-up on our website for those of you that wanted to have some information about the market's key movements there while David was out of the office. And one of the things I mentioned there, in addition to mentioning to you guys regularly in these presentations, is that we have started to see quite the outperformance of foreign developed markets that are out there. And those would be things like continental Europe. Those would be areas like Japan and Australia. And so those have been good areas to be in here recently and have even outperformed the U.S. markets, which we haven't been able to say for quite some time. So there is a little bit of a baton passing that's been taking place here recently. And a lot of that is as a result of what's happening down here in the lower left-hand corner. You'll note that that's the only chart on the board that has the dark pink shading. We do have a light pink shading over here with U.S. Treasury yields kind of balancing out or closing out at about a 1.6, or actually it's 1.76%. But the dark red or the dark pink shading in the lower left-hand corner is the U.S. dollar. And the US dollar has really fallen out of bed here in the last month or so. And remember, when the US dollar becomes weak versus other currencies around the globe, foreign stocks and foreign instruments oftentimes outperform on a relative basis. Now, be aware, as I mentioned in the write-up yesterday, that we did have oversold conditions there in the US dollar. That could be part of the reason why UUP actually bounced today. It was up 0.23%. So don't be surprised at all if we get some sort of a dead cat bounce starting with today's move. But the real question will be whether there's enough oomph out of that move to click back into that bullish trend that it was in earlier in the year. And right now, my expectation is that that will not happen. Of course, I will await each day's information as you guys all do. But my assumption right now is with that moving average bending lower and colored in red there for our eyes to visually see that price is now below a falling 30-day moving average, my assumption is that this is a bit of a trend change that's taking place here. We have gone from an uptrend in the US dollar to now starting a potential downtrend in the US dollar. And if that does hold true, then make that assumption that foreign stocks, whether you're talking about developed or emerging, may very well start being the leadership areas of this market and kind of overtake the US markets that have been carrying the bullishness for quite some time up until now. You also saw the real estate movement take hold here in the last 3 or 4 days. We were down today on VNQ, but that was an awfully nice bounce off that moving average. In fact, we bought a REIT in my top-down trend trading class here yesterday. In fact, we own 5 REITs at this point and 6 utility stocks, so we're kind of maxed out with the interest rate sensitivity trade in that particular class because that has been something that has been occurring for the last several months. This is not a new tendency for the markets. However, at some point you would believe that that trend will eventually end. Right now, I don't know if I'm willing to go on record saying that today's slight pullback in VNQ is going to lead to a disastrous scenario for real estate in the near term. In the long term, I do tend to think that both the real estate and utilities areas are overvalued. But remember that those of you that are traders are going to basically try to abide by where is the current momentum. And with those areas, we do still have some decent momentum there. So I don't think I would just outright sell them here until I start seeing broken levels of support and different things like that. All right, let's go ahead and take a look at another 12 grid here. In this case, let's go ahead and talk about the U.S. sectors now. This is chart 5C for those of you that are following along at home. Now you'll note that the utilities actually finished higher here today. They were up 0.42%. Mentioned them a moment ago as a place where we have some pretty big exposure in my top-down trend trading class. And we closed above that moving average again. There was some question about a week ago of whether that was a move that was kind of stalling out there, but we've had a nice little bounce here for really the last 5 days for the utilities, all 5 of those to the upside there, as you can see. Real estate was down today, but as mentioned, they were up the 3 previous days at quite a nice, healthy pace. And while XLRE in this case did not go to a new multi-month high, at least on a closing price basis, it's up there in that general vicinity of where it was trading at the beginning of September. So it, of course, is trading above a rising moving average, similar to what we can say for utilities. And both of them would be deemed to have strongly bullish postures as of this moment in time. What I can say is that with today's pullback, we have seen a little bit of a deterioration from a sector perspective, even from just yesterday. The communication sector really got whomped here today. It was down nearly 1%. It's a pretty aggressive looking candle there, and you're right back down to that falling moving average all of a sudden as well. In fact, if you look at kind of a broader pattern there, you will see a trend of lower highs if this high ends up holding true. In fact, you could probably make the claim that it's still lower highs and lower lows, because the long lower shadow of this candle back here on October 3rd was slightly lower on an intraday basis than some of these candles back here. So communications is kind of stuck in a holding pattern. Even if you just look at that chart, it looks more sideways, choppy sideways, but definitely sideways. Whereas when you look at the utilities and the REITs, they're still in an uptrend. At least that's what my eye sees. indices. When you're looking at technology, you'll note that technology got whomped today as well. It was down over 1.35% in this particular case, kind of similar to the communications area. It's down back to its moving average all of a sudden there as well. And that makes sense. You know, we talked about the NASDAQ being the worst index today. It makes sense that technology was the worst performing sector today. Of course, a lot of technology stocks reside on the NASDAQ composite. I also saw after hours, by the way, brace yourselves. Texas Instruments was down significantly on their earnings announcement. And of course, they are one of the key leaders within the very important semiconductor index. So that all by itself has the possibility of pressuring technology stocks even further going into tomorrow's open. So let's keep our eye on that story as well. Other stocks that were reporting, I think, were Chipotle and I think Snapchat, iRobot. There's a few of them that were out there. So anyway, we are in the heart of earnings season here. Of course, some of them will come out positive, some of them will come out negative, but you want to stay vigilant there if you are a shorter term trader. Many of you know that are following me on Twitter know that I'll do kind of a quote retweet of all the stocks that are reporting earnings in the coming week. I usually do that on Sundays, so another reason to be following me on the weekend if you're not doing so already. All right, let's go ahead and move on to the internet here real briefly. Wanted to bring up the market outlook post from last time that I did this back on Thursday, at least the video portion. Again, yesterday I did the write-up that was posted here on our website for those of you that want to read that. But the last time I did the video was on the 17th. That would have been last Thursday. Thank you to the 98 people that clicked like. Most of you are aware that I kind of set 100 as my goal in terms of that, so I did fall a little bit shy there. As a reminder, it takes about 2 or 3 hours for us to produce, edit, construct, research these videos. And so if you get value out of them, remember they are free. So all we ask in return is for you to click like. For many of you, you've trained yourself to be able to allow that. For some of you, you just haven't fallen into that habit quite yet, and some of you don't have Twitter accounts, and that's fine, but I do know that at least 300 of you have Twitter accounts because we did a promotion once in the past where over 300 of you liked it. So I know that 2/3 of you are intentionally deciding not to like these videos every single day that you watch them. So if we could train you to get back into the habit of doing that, it would go a long ways. It allows David and I to justify the time that goes into these videos, and doing a write-up like yesterday, I had a decision. David was out of the office. Do I do anything? I could have just let it pass, or do I spend half an hour to an hour to do the write-up or what have you? And the same thing goes with these videos. We regularly have these discussions. Do we want to have these videos every single day, or do we want to kind of revert to what a lot of other organizations like ours do and do a weekend recap once per week? I think many of you want these to be done on a daily basis, so we're going to put that responsibility, that ball in your court. If you actually want these done on a daily basis, then you have to help us along by clicking like on Twitter there as well. As long as we're above 100, we don't have issues. Once we start going below 100, then that's kind of the cutoff where we start making these kind of more difficult decisions. So don't fall asleep on us there. We're going to do our best to stay vigilant for you here and point out any sort of interesting market movements along the way, and hopefully give you guys a good educational experience from a completely free capacity here on YouTube. All right, with that out of the way, let's go back ahead and get over to our charts again. And let's go ahead and talk about the foreign stock markets now and do our 12 grid analysis here. In this case, let's start with the primary global stocks. This is 5E for those of you that are following along at home. Here you can see it's a clean sweep for the bullish postures. It's green across the board, all 12 of these. The only one that has a light green background, in fact, is Russia. And that's because it's at 49.95 and rising. In other words, it's about as close you can get to a strongly bullish posture without actually having one. Remember, once that goes above 50, it would revert to a strongly bullish posture. So really, things look even better than first glance from that perspective. The areas that are outperforming are Japan, as I've mentioned many times in the last couple of weeks. Also, I've been starting to bring up Germany right there, South Korea, and France. France is pulling back a little bit over the last week, so that one's not quite giving us that oomph that we would want. but it's kind of being replaced right now in my own head by South Korea. That's been a nice move out of South Korea right there, hitting new 3-month highs there. And then to throw one out there to keep on your radar that we might want to keep our eye on, Brazil, all of a sudden. Look at this chart in the lower left-hand corner. We kind of forgotten about Brazil for a while, and then all of a sudden the last 2 days it's showing some meaningful progress here as we're bouncing off that rising moving average, and all of a sudden with today's move, this is the highest close on Brazil going all the way back to this candle back on August 9th. So all of a sudden with just 2 days we've had some really good progress there on Brazil, and there are a number of individual Brazilian ADRs that trade in the United States that you might be able to take a look at there in addition to just looking at the country through ticker symbol EWZ. From a slightly secondary perspective, you don't want to say that in a negative light. We're not here to, to do that, but we got to be able to describe what's our first 12 versus our second 12. So we call this our secondary global grid here, and you're going to find some of those other very important economies around the world, while they might not be quite as important as areas like Japan and Germany. So as we look at this second grid here, you can see there are 2 charts on the board that are pink. We've got a light pink shading in the lower left-hand corner, and that's Switzerland. We also have a dark pink shading right next to it, and that's Argentina. Now, Argentina has been down and out ever since this massive gap down that took place here on August 12th. And it's a reminder that when something completely falls out of bed, it is hard to catch a falling knife, because you might feel like you're getting the world's greatest value ever. And that stock, or in this case, the ETF that tracks the country of Argentina, it was one of the worst country meltdowns we have seen in the last 50 years for a major country. I think it was in the top 3 of the biggest moves in the last 50 years. Well, had you been a buyer of Argentina that day, you are still down significantly since then. I know at that time you probably couldn't resist the temptation of buying an entire country that fell out of favor, yet it really hasn't benefited you, and we are still languishing here on Argentina. We remain below a falling moving average with a bearish posture at this time. In terms of what's working on this secondary grid here, Taiwan, I've pointed out a number of times recently, that continues to work. So that's EWT right there. That's hitting a fresh 3-month high. Sweden is also working right now. It didn't close quite as nicely as Taiwan did, but we did hit a 3-month high on an intraday basis on Sweden. We also had a nice move out of Spain here recently, although it's kind of an ugly pullback that we saw out of Spain there today. So, of those that I just mentioned, I would say that Taiwan looks the most interesting, because not only is it in a significant uptrend above a rising 30-day moving average with a bullish posture, but it also finished higher today and finished somewhat strongly, whereas a lot of the other markets did have a little bit of a bearish ending to the day. Okay, so with that information out of the way, let's get into our trade application. For that, I want to come on over here to chart 3A. This is the swing trading chart that we use in my factor-based swing trading class on Wednesdays, which, by the way, for those of you that are premium members, I'd invite you to tomorrow, 2 p.m. Eastern Time is when I conduct that class. And we've had quite the hot streak over the last several months in that class. In fact, we just closed out another profitable trade here today. In fact, it was the one that we bought last Wednesday. We plan on being in our swing trades for 3 weeks or less. We love it when we can get out of those trades at max profit within 1 week's worth of time, and that's exactly what we did with last week's trade. So we're going to do it all over again tomorrow in class if you want to join us to see if we can pick yet another winner from a swing trading perspective. Anyway, this is the chart that we oftentimes will use in that class, and it does emphasize the blue near-term line on the market forecast much more so than the green line, which is what you oftentimes hear David and I discuss during these presentations here on YouTube. So I wanted to show you something that caught my eye with a very popular growth stock of our day, and that's Lululemon, of course, the big yoga wear manufacturer and retailer out of Canada. And one of the market forecast signals, trade signals that we look for is divergences, near-term divergences. And we do have one that I wanted to make you aware of on Lululemon. Now, this doesn't have to mean that it's going to wreck its current intermediate uptrend or anything along those lines. But from a shorter-term perspective, it does appear that there is some reason on the chart to expect a little bit of a pullback here in the coming, let's call it, couple of weeks. And so as you can see, we've got point number one, or peak number one, I should say, on the blue line down below. That's the near-term line on the market forecast that you can get on the Thinkorswim platform. So that's peak number one from that blue near-term line perspective. Notice that it's in the upper reversal zone. Peak number two is right here. It's just a hair below the upper reversal zone and is clearly lower than peak number one. Now look at the associated candles, and you'll notice right here that this candle, this price candle, is associated with peak number one on the blue near-term line, and then this candle right here is the price candle associated with peak number two. So in other words, price went from here to here when the underlying indicator went from here to here. Higher highs on the price, lower highs on the indicator. That creates a near-term bearish divergence there. And so what I thought we would do, now that we have a bearish posture on this as well, notice the pink background color of the chart, is do a bear call spread on Lululemon. So I'm going to come on over here to the trade tab. You can see I've got the trade loaded up down below. I'm using the November monthly contracts in this case, and I'm selling the $212.50 call, and I'm buying the $215 call. That's creating a credit of 62 cents, which is more than the 30% return on risk that we oftentimes shoot for. So when I click confirm and send, you'll see that our break-even price is a hair above $213. In other words, we would win this trade if this stock stays below 213 for the next 24 days until the options expiration day. And of course, this stock is trading at about 204 right now. So we've got a little bit of a head start, like a $9 head start there. If it continues to go up, we are covered. Our worst case scenario is that we lose $188. And that's the whole point of having a purchased call strike within that spread itself. So let's go ahead and send that in, and we'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here yet again. I will be back with you on Thursday. Remember, David is on vacation this week, so he won't be here tomorrow for his normal presentation, or on Friday. However, my plan right now is to do that write-up. So check our website and on Twitter if you are wanting to read that write-up. And if you get value out of that and appreciate that, be sure to click like for us there on Twitter as well. It's your way to cast your vote to us that you want us to continue to do these videos and write-ups for you in the future. So quick recap, we do have bullish postures on the S&P 500 and the Russell 2000, but we now have bearish postures on the NASDAQ Composite and the Dow Jones Industrial Average. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.